You've always been told that owning a home is the best way to make money. Think about it. Ever since you can remember, everybody has told you that owning a home is the right thing to do. And I'm here to tell you that owning a home can be great for helping you achieve financial independence. But mortgaging a home is absolutely one of the worst things you can do to your finances. The rules of the mortgage game are so stacked against you. There's a good chance that you'll never own that home outright, and a 90% chance that you will in fact lose money. The bank's profits depend on the fact that you will lose money when you mortgage a house. Just like a casino can pay its bills because they can depend on you losing money. In reality, it would be better to simply save your money in a non-interest bearing account than mortgaging most homes. That's right. It would be better to simply put your money in a zero interest savings account with FDIC insurance than to mortgage most homes. This is the truth about mortgages. This is what most financial gurus either don't know or won't tell you. Say you want to buy a home for $200,000. It's in what you think is a decent neighborhood. And you get a decent rate of 5% interest on a 30-year mortgage. Your payments are about $1,400 a month. In 30 years, the house is worth double what you paid for it. You pay off the mortgage and sell the house for $400,000. You've made a great investment, right? Not really. In 30 years, your principal, interest, taxes, and insurance has come to over $503,000. So you have actually lost $103,000 over 30 years. This is factoring a property tax rate of 1.2% and an insurance rate of about $1,500 per year. Depending on where you live, these rates will be dramatically different. It gets worse. Your PD payments don't factor any maintenance on your home in 30 years. You'll have to cut the grass, shovel the snow, paint the house at least once, fix the deck, and most likely get a roof within that time frame. An extremely conservative estimate for maintenance on your $200,000 home is $200 per month. That means in 30 years, you will have spent over $72,000 in regular maintenance without any major updates. This is also considering you don't miss any payments on your mortgage. That puts your total cost at $575,000 for your $200,000 home. That means you lose $175,000 even if your home doubles in value. Over 90% of homes have not doubled in value in 30 years. Many homes actually lost value, but your mortgage payments stay the same. What if you lose your job within 30 years and can't pay your mortgage? You lose your home and you don't get any of that money back. Or if people around you, your neighbors, can't pay their mortgage, your home values will go down dramatically even though you are making regular payments. During the 2008 financial crisis, some people's homes lost 90% of its value. I know that for a fact because my home was one of those homes. In order for a mortgage to make sense, your home must appreciate at a rate significantly more than the interest rate you're paying. Ideally, your house would appreciate at twice your interest rate. So if you have a 5% interest rate, your house should appreciate by 10% a year if you want to guarantee that you'll make money. Sounds crazy, right? There are some neighborhoods where this has happened. Property values in places like Denver and Los Angeles have appreciated by huge amounts. But those places are the exception, not the rule. Now, let's say instead of mortgaging a house, you took those mortgage payments and put them in a bank. Again, let's pretend you're getting 0% interest from the bank, which is not far from reality. $1,400 per month into the bank after 30 years is $504,000. Read that again. $504,000. Ironically, that is the same amount of money that you paid out on your $200,000 loan. If you found a way to get 5% interest per year on your savings, you'd have over $1,146,000. Way more than your home value. Now, I hear some of you saying, but you still need a place to live. But even if you saved half of that over 30 years, you'd still have over $500,000. Your investment also would not be subject to changes in the real estate market, property tax increases, storms, earthquakes, or things completely out of your control. Because when those things happen, your insurance doesn't cover the payments you made. They only cover the original value of your home. Your savings, on the other hand, has $250,000 worth of free FDIC insurance. If anything happens to your money, you should be able to claim it. When your account goes over $250,000, you simply open another account. If you need a house, you should pay cash for your house. Do whatever you can to get that cash, or buy the house with some friends or family together. This is nothing like the dream that you were sold on, is it? The only time you should even consider getting a mortgage on a property is when the value you receive back is significantly more than what you paid for it. For example, if you have a tenant paying you $2,000 per month and your mortgage is only $1,400 per month. If your house isn't giving you a return on your investment, then you shouldn't be taking out a mortgage on it. My name is BSG, and I hope that you'll consider this information before you even think about getting a mortgage.